get some hot coffee. Yeah, baby. Oh, I guess that's it for the music. Hey, how you doing, FX Street? 225, baby, 225. Come Televu, how are you? All right, let me kill the music. All right, hello, hello, hello. How are ya? How's your mom? Welcome to Trade Non-Farm Payrolls 225. That is getting pretty close to, well, 19 years. Yeah, 19 years, huh? Yeah. So anyways, hey, FXStreet, welcome to the thing we call Trade Non-Farm Payrolls Live. It started way back, a century ago, and the leadership of FXStreet and I got together and said, let's do something special. Let's do something unique. Let's use the live markets as an opportunity to teach people how to be conservative and disciplined and patient as a trader. So today we're going to cover technical and fundamentals. We can cover trader psychology, but ultimately you're the boss and I am a humble servant and I am here to share. So you let me know what you want to do and we can do that. Now, typically we spend an hour prepping for the news at 8:30. And then around 9:30, well, at 9:30, the stock market opens. So we have this like prep for the news and then react and respond to the news. And then usually we have an hour of Q&A to cover things that you want, like how to spot, how to scalp, how to swing, how to carry, how to do fundamentals. Yeah, that kind of stuff. And so really, ultimately, we can do what you want to do. I will leave lots of opportunity to get that covered. Let me know how I can help. Neat, right? Yeah. Oh, the chat isn't in there properly. Let me get the chat link. Hang on. Sorry about that. I like to have that in there just to document history, so it's in the recording. Oh, now I have to go to the other thing, and then on that thing, I gotta click on that thing, and then I gotta click on that thing, and then I gotta go here. All right. All right, so there we go. Good, good. So I hope you're doing well. I hope that fits your agenda as well. This is 3 hours. I don't think FXStreet does any other 3-hour webinars, and yet this is year 18 and a half. Could I comment on the euro dollar? What would you like me to say? Okay. So anyways, let's get going. Because you should have facts. Now, when it comes to non-farm payrolls, I wrote an article for FXStreet about, I don't know, I'm guessing about 10 years ago, and they turned it into this form. I said, you should take a look at the previous history in NFP. So they do now. I said, you need to look at Challenger, Christmas and Gray, which nobody talked about before this article, and now it's part of the FXStreet page. Initial jobless claims, I said, look at the trend, continuing, all that stuff. I said in the article, look at the ISM services and manufacturing employment subcomponents of ISM, which nobody talked about before that article. Now it's all integrated. I said, they've added here consumer confidence, which is fine. It's not really confidence that matters, so I would argue against this, but I'd say future inflation expectations, which is also part of UMich. So it's not the con that matters. It's the inflation expectations. ADP and JOLTS. Yep. I don't think I had the conference board in there, so they added a couple others. But, you know, that was 10 years ago, and now it's part of FX Street. How epic is that, right? Okay. Yeah. Well, okay, so there's a question already, like, how does NFP impact the dollar? Well, it doesn't. It's people's response to how they think NFP will change the policy at the Fed. So you have to understand monetary policy and such. So I run an organization that automates your technical and your fundamental analysis. And then we also provide, I don't know, about 5 hours a day usually of performance coaching. But my name is Wayne McDonell. That is me. I aged a little bit, but this is me leaning against the FXCM building on Water Street, I think it was, in downtown New York City. I don't even know if it's there anymore. But anywho, I have a background in trading and investing. I was a venture capitalist. I worked with George Soros. I wrote a book, Strategic and Tactical Forex Trading, Speaker of the Year at FX Street. I have a bachelor's degree in macroeconomics and a master's degree in financial management, both from Harvard University. I also studied the algorithmic trading program at Oxford. I completed the cryptocurrency course taught by Gary Gensler at MIT. He only did the one course. I was a student. Then he ran the SEC, and now he's out of a job. But anyways, I still do what I do. Gary Gensler's had 5 jobs, and I've only had 1. Yeah. And what else? I studied alternative investing at Harvard Business School. Those last 3 things were all postgraduate work. So anyways, neat. So I've been doing this for over 20 years. Great. So I've seen a lot of things, done a lot of things. I mean, just think about it. This webinar alone, I've been doing for almost 19 years. Yeah, with FX Street. Isn't that cool? So we're going to use this resource because it's a good way for us to go through the fundamentals and technicals and stuff like that. Great. I can do more than in 1 minute than most Forex traders can do all day. ThankYouTraders.com. Cool. We're not a broker, though, and so you're going to need a broker. And I suggest you have an ECN. They use straight-through processing. They don't trade against you. They execute your trades. That's exactly what you want. They're affordable. They're fast. All this is just factual. But the key thing here is you want an ECN. So, look, if you don't like Trader's Way, don't use Trader's Way. I like Trader's Way. I think they're good people. I've known them for over 10 years. Cool. So find an ECN, start doing your research, and maybe start with Trader's Way. In my humble opinion. Let's take a look at fundamentals. I think I'm logged in. Oh, good. Oh, yeah, I'm logged in as an admin. So you might get this every once in a while. So please ignore that. All right, so let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, did you click the thumbs up button and thank FX Street for hosting us for the 225th month in a row? Have you done that yet? There should be close to 100 thumbs ups by now. Thumber uppers. All right, so look. So we're just logging into the main dashboard here at traders.com, and we're looking at the fundamentals because we're trying to assess how the market is lined up for NFP. Now, remember, yesterday the markets were closed in observation and memorial to President Carter. On Saturday, I drove out to his family home in Plains, Georgia. It was about 2 hours away in the middle of nowhere. So I drove out there and I sat on his farm, and nobody was there. Not one car, not one other person, no security, no parks people. There wasn't even a squirrel. So it was just me and Jimmy. Isn't that wild? Yeah. So anyways, so the markets were closed yesterday. And so we're going to have sort of unreliable and wacky technical analysis. Because remember, technical analysis is a self-fulfilling prophecy. But if there's no people, there's no prophecy. Right? Like, so the technical analysis, I think, is going to be a little bit less reliable than normal, especially on the short run. On the long run, it should be fine. On the short run, for you guys at like the 5, the 15, and the hour only, it could be a little different than you would expect, because you got basically gaps and low vol in your whatever you're using, oscillators and moving averages and stuff. They might be a little bit off. So just pay attention to that. Okay, 10-year T-note, the yields are up, oil way up. So this idea that a couple of weeks ago, President Biden basically banned offshore oil drilling in a huge part of the Gulf of Mexico. And spaghetti-o. People are worried about supply in the future. Also, we had some auctions in Alaska and other parts of the north, the Arctic, and nobody's interested in drilling there right now, maybe because it's expensive or a pain in the butt, or maybe we have enough supply. But if we have enough supply, then why is prices going up? So this is a threat to future supply. So anyways, oil went from 67 to basically 77. Like, wow. That's a big move in the last couple of weeks. But there's also pivot points involved with this. Gold finally got back above 27, 59 on S&P. We've been there for a while. We're thinking about maybe going back to 6 or maybe going back to 5. We'll see which one first. Dollar index still above 109 and Bitcoin still below 95. Great. Our hit list for bullishness, dollar strength. Our hit list for bearishness, dollar strength and yen strength. Currently, the market evaluation is mixed. Taking a look at multiple time frames, and we're not. Let's see if I can reload that. One of our data providers is glitchy. Yeah, one of our data providers is glitchy right now. So I unfortunately I can't get longer term data. I can tell you it's leaning risk off. Okay. Now, it's because we are not getting dollar. All right. We're not getting dollar right now. And so therefore we can't load this. Okay. So that's fine. We can do it. Let's look at the last 30 days. The put call ratio favors bears. But it's relative, right? So over the last 30 days, over the last 7 days, it also favors bears. So we'll go with that. Volatility is up 23% month over month. That's bad. Gold is flat. So therefore, neither here nor there. Stock market's down 2% month over month. That's bad. Yen is down 3%, and that's great. But just mostly in the last 30 days. More recently, nothing has happened. Okay, 10-year Treasury yields are up, and that's bad. 2-year Treasury yields are up, and that's bad. And most likely dollar is either neutral or strong, so it either makes it about the same. But let's add it up. We'll count dollar as flat. So $0, okay, 1, 2, 3, 4, 5. So that's -5 plus a 1, -4. So at -4, it's quite bearish still. take a look at the scatter plot. This is what's going on in the world right now. Oil is on, Oscar Mike is what we say, on the move. It's hot to go, HOTTOGO, a threat to supply by Biden. Yeah, and he's done it in such a way that it will be very difficult for President Trump to reverse it. So here's the thing. That policy really didn't matter because I don't know how much drilling wanted to get done there anyways, but banning it is a threat to supply, pushes prices up, and guess what? If inflation comes back, the number one contributor to inflation right now is energy. And so in Biden's last 2 weeks, if he banned the future supply of oil, he just pushed inflation up. And he did it in such a way it'd be very difficult to undo it. So there you go, yo. So let's get rid of that. And let's take a look at the normal level of the scatter plot. For those that are new, let me explain, if you don't know how to use a scatter plot. So traders.com, we have scorecards, right? So what we do is we look at the macroeconomics of US dollar and of Japanese yen, and we score it. And then we do a comparative analysis between the two to create an overall score of, you know, the logic would lean towards USD yen being a little more bullish. And we know that because it has a score of 1, comparing the two economies. Okay. Now, when you look at USD Rand and compare the United States economy to the South African economy, it gets a much bigger score of 10. And what this means is, like, here's all the things that should be in theory. Remember, it's just macroeconomics. Long term, we call this strategy. You would think through the macroeconomic analysis that these assets would be more to the up. And then using the same logic, comparing these economies together, you'd think like Kiwi yen would be down, Kiwi dollar would be down. So our macroeconomic analysis of New Zealand must be quite bearish because they have such negative scores. So to say it differently, everything in this lower quadrant should be bearish, or is expected to be bearish. That's all, not should be, expected to be bearish. Everything in this upper right quadrant is expected to be bullish. Everything down here, okay? If it's down, that's unexpected. We expect them to be up. We expect Nikkei to be up. We expect FTSE to be up, okay? But we're looking at 8 or 9 or 10 variables to make that judgment call. Doesn't mean it has to be up. There can be conflicting things, or this could just be short term. In fact, if you think it's up but it's down, it might be a buy a dip type scenario. And then, of course, everything with these negative scores, but they're over here. Why are they over here? Well, let me explain the other axes. This is what's happening right now. So euro dollar is up slightly, not even 0.2, but it's up slightly right now. Oh, but Wayne, it's got a negative score. Yeah, but it's up. So it's bullish right now, but that's unexpected on the long term. So maybe it's a sell a rip scenario. Okay? And so we can isolate this further and try to figure out why this stuff is going on. And let's see, dollar strong, dollar weak, dollar weak, dollar weak, dollar weak, dollar weak, but dollar strong. So Australian dollar is very, very weak right now. And it looks like the US dollar is fairly weak, but Aussie dollar is very weak. So you can sell a little bit of USD, but you probably should sell a lot more Aussie is how you'd read this. Okay. And it's supposed to be down. It's got a score of -11 anyways. You see how cool and insightful that is? So the bottom is strategy, and the up and down part is tactics. What is actually happening right now? Taking a look at the money market, we are neutral. The 2-year yield, which we call hot money, is at the 8-day moving average, which is, well, it's elevated, but it's not getting worse. It's sort of neutral right now. If it crosses below the 8-day moving average, that would be good. That would be good. That would be bullish. Cross downs are bullish for the things like the stock market. Why? It means money is cheaper to borrow. It's like your landlord showing up and saying, hey, man, you're such a good tenant. I'm going to lower your rent by 5% this year. Sweet. It's good. Now you can get some more brewskis or pop money into your retirement account, huh? Okay. You know what? Abdullah brings up a thing. Hey, what motivates you in the morning? And if you had a bad day, you know what? I led the swing trading group last night, and because of the holidays and because of NFP and because of a bunch of things, I didn't really want to talk about charts. And we ended up talking for about 2 hours about trader psychology. And I specifically answered that, Abdul, how to recover from a bad day. I talked about that probably for a half an hour or more. So that would be over here. Let me scroll up a little bit. Let me show you where you'd find that. I'll open this in a new tab. Oh yeah, I got a bunch of announcements I should be making too. All right, so cool. So you go to last night, it was here. Okay. So we started at 4 and it went to almost 6. So not quite 2 hours. Well, it's Thursday, the greatest trading day of the entire week, because we prepare for next week. This week. All right. So this is us last night. Cool, right? And so we talk about that, and maybe if I skip ahead a little bit. I don't think it's going to be there, though. This is skip ahead. One of the worst is confirmation bias. You see what you want to see. There's a game called Punch Buggy. Does everyone know this one? So anyway, the whole thing was on trader psychology, managing your biases, managing your psyche, managing your discipline. At that kind of thing, like the ball is thrown 1 yard in front of you. I'm open to it. He doesn't like me anymore. David Pigler made out in San Diego. It might. So anyways, so it was pretty good. It was pretty good, So that, yeah. So like I said, definitely spent a half an hour on that. And so the whole session ended up being trader psychology. So anyways, oh, look at that. We got double reminders for today's event. Cool. How interesting is that? Neato. And, oh, hey, if you're part of traders.com, don't forget Brian is doing a session today on cryptocurrency at 11. So right after this is done, we have a session Sunday early afternoon. Then we have a session Sunday night. Then we have a session Monday early morning. Okay, so on and so forth, Monday afternoon. So we got a big week next week. All right, so I wanted to show you this. I forgot. I did an annual outlook. Where did it go? Okay, I did an annual outlook. Okay, guess this is it. So this is the recording. I just want to make this, I suppose, remind you that this presentation I did 2 days ago will still be online for 5 days. Okay, it'll still be available for 5 days, and it was about 2 hours long, almost precisely 2 hours long, and I cover what I think is going to happen in 2025 in regards to monetary policy and fiscal policy in coming up by going into the past and reviewing an analogous situation. So people will now understand, like, if or when Trump tariffs, what is likely to happen this year based on what happened last time. If the Fed cuts or raises interest rates or pauses, what is likely to happen based on this year based on what happened in the past, and how does the combination of these two forces work? So we covered all that in massive great detail. I also built a whole bunch of charts, maybe 10 charts at the Fed, and we went through all that kind of stuff so you can see, you know, total money supply, change in money supply, and a bunch of other very interesting things. We covered mortgage rates. We covered a bunch. It was all there. So that's here, and in 5 days, it will be removed. And the next session is going to be in April. If you want access to this recording and the other 3 events coming up, this is the link. It's $50 for all of them. All of them. Okay, all of them. Do you have to be a member of traders.com? No. Okay. Cool. And so a few people said they were there. I had a lot of fun. I thought it was pretty cool. I thought it was good. Again, it will allow you to understand what is likely to happen in 2025 by completely understanding what happened in the past, with the removal of my opinion. So anyways, most of you were there, but for those that weren't, just a heads up. Very, very, yeah, thank you. Awesome, 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 awesome. And the other thing, gee, see, I'm just so into the fun stuff is the trade setup. There's one last thing I'll let you know about. Traders.com. There's a super secret code right now. I don't think I even emailed it out. But if you're not a member of traders.com, check this out. Go to Traders Pro Monthly. Let's see if it still works. You type in coupon code New Year 25, I think it is. Apply. And it drops $600 a year off the membership. $250 a month instead of $300 a month. And that gives you access to everything. Yeah, forgot about that. Cool. Coolio. So, get sales pitch done. Let's move on.com. All right. So there's the change. The hot money is neutral right now. Obviously, probably waiting for NFP, right? Okay, we'll look at the options market. And so we clearly saw this coming. And so it's relatively bearish as we saw the change in positioning in the 1 million options we analyze, right? Of the option contracts we analyzed, the relative change in those positionings was more bearish. That's why we got that negative score on the risk gauge. But it's still absolutely, which means the static aggregate of how many bulls versus bears, the market is still on aggregate bullish, but relatively less bullish recently. Okay, you see? So that's kind of where we are now. Let's take a look at the heat map. Let's see what's hot and what's not. Platinum is the biggest winner. Okay, this is week over week. Platinum is up to almost 10%. Copper's up. Silver's up. Oil's up. Treasuries are up. Gold is up. You know what this means? Inflation, inflation. Here comes inflation. See, you want to own real assets when you're stagnant. So if you believe in a world of slower growth in 2025, but higher inflation, guess what? You want to own real assets. You want to own food. You want to own metals. You want to own real estate. You don't want to buy real estate. You were late. I gave everyone the heads up when to buy real estate. That was right before, right as COVID was hitting. I'm like, buy real estate. But anyway, so that's long gone. Great. So real assets are performing best, which is an interesting sign of plausible inflation. And then you look at some of these, like, especially if you're analyzing the United States, all of a sudden you're like, hey man, why are treasuries up? Why are commodities up, but the stock market's flat week over week? Because, right, look at this, S&P 500 flat, Dow even more flat. Where the heck is Nikkei? Okay, can't even find Nikkei, not Nikkei, Nazi. Where the heck is Nazi? But the thing is, what it's showing you, here's Russell, flat. What it's showing you is financial assets are not that attractive. Oh, there it is. Nazi is over here. So NASDAQ, S&P, down, Dow, Russell, they're all flat because financial assets don't perform well in stagflation, but real assets do. Okay. Okay. Explain what will, okay. Yeah, you know, when you ask questions like that, like, can you explain oil analysis? You're just telling me you're not connected, right? You're like, wow, really? So like we plot all of that information at Traders. So, and I'm sure you can find it all at FX Street as well. Got to keep an eye on the time. So anyways, what are the dogs? Nikkei is selling off, so you'd expect a strong yen. Either dollar strong or pound weak, but notice the bad things are not that bad. And the good things are great. All right. Commitment to Traders report. I go over this on Mondays because we're updated on Fridays. You can review it over the weekend. It shows you capital stock and capital flow of institutional investors like hedge funds. Okay. Right? Very good, right? And so you'll understand, like, some markets are going up, but nobody's buying, which is really interesting. So you have to know this. It comes out typically on Fridays, but with all the holidays, they've been coming out on weird days. Right? But you should have this. And so I think the next one comes out on Tuesday, which is strange. You know what else is strange? My property is covered in snow, and I live in Georgia. No, not Georgia, Eastern Europe. Yeah, Georgia, United States of America. And I'm covered in snow today. Whoa. Yeah, welcome to the club. So anyways, so you need to go over this. And then from that, we can extrapolate the positioning of the entire market right? We can, well, here's the COT, the Commitment to Traders report. This is all the institutional positioning because you just extrapolate and pull it all apart so you can show, are hedge funds long or short CAD? Are they long or short the Dow? But then, right? Then you can also extrapolate the retail positioning. Retail is heavily short Euro Kiwi. Well, what if that's wrong? Yeah, and they probably are wrong. Yeah, why are they wrong? Well, it looks like retail's trying to sell Euro Kiwi Yet institutional investors are 82.71% short Kiwi. And yet retail's buying Kiwi. Okay. Okay. Cool. We can skip ahead a little bit here. So we can analyze things, by the way. If you want to see in 17 minutes and 48 seconds, non-farm payrolls, we've already broken all this down. Okay. If it's less than 160,000, we've already analyzed all the major pairs on 5 different time frames each and analyzed. So if it comes out less than 160, there's a scalp on Aussie dollar, a scalp on euro dollar, but there's no scalp on pound dollar. There's a scalp on Kiwi dollar. There's no scalp on USD CAD. There's a scalp on USD Swiss franc, and there's a scalp on USD yen. We also have the probabilities. Now, how do we derive these probabilities of up or down? Look at projected trend based on this particular news, based on this particular asset on this particular time frame. So I can go from a scalp to a day trade to a swing. They're not, right? They're not necessarily lined up. Well, how do we know that? Well, that's a good question. I'll show you in a second. All right. Now, what if it comes out greater than expected? Now, this is where I sit here. Now, a lot of experts are saying lower than expected. For me, I don't know. I'm still sort of a greater than expected guy. And if that comes out, well, there's a scalp, 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 scalp. Everything has a scalp. Okay. But the directions are different because of the numerator versus denominator. Great. So how do we get to this consensus? 87.5% chance Aussie dollar falls in that particular scenario, because we have all the data going back through history and we've analyzed them on all time frames. And I can say, okay, if it's greater than expected, show me the 2-hour trend and why you think it'll be down. And it goes like this. Now I zoom in and only focus on the selling trade plan that I would expect if I were me in 15 minutes and 43 seconds, 87.5% chance based on past performance if I get the outcome I expect. And back in December, it was up and then a drop. It was a pop and drop. In October, it was a drop and stayed low. This one moved sideways and then dropped. This one dropped and dropped. Okay, this one dropped and also closed lower. This one popped and then dropped. This one dropped and then continued and closed lower. I have the data, mofo. Oh my God. You're like, well, Wayne, show me the other way. Okay. No, but then Wayne, don't show me that. Show me the 12-hour. Okay. And show me on the CAD. Okay. And show me the, okay. I have all the data pre and post on all time frames, on all majors, based on non-farm payrolls, also based on time frame and based on positive or negative differential between expected and unexpected. Holy snap! You trade Forex and you don't have information like this? Yeah, but I also have employed volatility, so I can also analyze what is normal and abnormal, and based on implied volatility of all these assets. Okay, now I have a lot of assets turned off, so let me turn them back on. I'll have to keep stocks off. Save. Great. Save. Okay, put it back. And now here's implied volatility for everything. Okay. And we're, right? Isn't this cool? And it's only looking at Fridays this time of day to give you implied volatility highs and lows on 3 different time frames, 1 hour, 4 hour, and daily for every asset for this time of day on Fridays. Holy smokes. What about gold? Yeah, what about gold? Here's silver. Here's gold. Here's Euro CAD. Like, I got it all, bro. All right, let's take a look at the technicals. You guys want to keep it Forex, or do you want to do commodities or stock indices? You like crypto? Let me go into settings. Let's do all Forex and only, what do you want to do? Let's do two things. Trending patterns and Fibonacci, basically harmonic patterns, right? Which are very often reversals of markets. So we have trends and possible reversals of trends. Okay, cool. And now we're analyzing all the Forex pairs on the 15-minute, the 30-minute, the 1 hour, the 4 hour, and the daily. So I can analyze 7,500 charts, and I can do it in a couple of minutes, and it might take you all day. So let's take a look at it. Euro Kiwi. Well, by the way, when we went in the fundamentals, remember how I don't know, let's do it this way. Let's just open that back up. Okay, so how do you think about the market fundamentally? What are your biases, Wayne? And base everything on macroeconomics, not on opinion. Okay, so I go here. This is my analysis of everything bullish, everything bearish. Isn't that great? Bullish to very bullish, bearish to very bearish. So I go through this and I have opinions on what I want to do. We call that bias. So then you go here, and now technical analysis doesn't give you a bias per se. You have to have a fundamental bias, and then you confirm or deny the bias using technical analysis. So let's just pick something like, well, let me do this fast because we're running out of time. I want to get to the charts. Let's change this up. Let's turn Forex off, except for dollar. Dollar, 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 dollar. I think I missed one, didn't I? We have euro dollar? Euro dollar. There we go. All right, cool. So let's say I'm a dollar bull today, okay? Dollar bull. So now I am looking at, what was that? 8, 10 different currency pairs on 5. So how long does it take me to look for opportunities on 50 charts? Let's say there was 10 dollar pairs and we're looking at 5 time frames. So there's 50 charts, right? Now I'm also going to say I'm only interested in bearishness because I'm fundamentally a bear. This is how I can do 50 charts. You ready? Kiwi dollar, non-directional. Okay, on the 15. Kiwi dollar, non-directional. Rising wedge, bullish, but this is a threat, so I'm a pass. Euro dollar, I want this to go down. We are non-directional with an up, that is a threat. USD Japanese yen, again, we're bullish on dollar. This is a break of an up to a downside, so that's a threat. Non-directional on rand, USD dollar. Okay, this is showing weakness, and this is an opportunity. Go to your Kiwi dollar chart, put it as a maybe. Aussie dollar, daily chart, downtrend with a down opportunity. The next leg is down. Look at your Aussie dollar chart today for a possible bearish entry. Possible. Now you have to go do your technical analysis. This is just patterns. USD yen, rising wedge, that's bullish, slight to the up, slightly opportunity on the longer term. Okay, I want to buy USD, and I look at this 1, 2, 3. No, I'm going to pass on that. USD yen, it's bullish, but potential break, but you could still look at this around 158, still maybe as a potential up there, so that's okay, but doubtful. That down for their daily. Kiwi, daily opportunity. USD Swiss franc, daily but a threat, pass. USD Rand, next leg is likely down, which is not good, and that's not happening, but that's a threat anyways. Done. I just did 50 charts. How long did that take? I had to say it out loud. I bet you I could have done it twice as fast if I didn't have to say it. So they're not signals. These are not signals. This is just patterns. You have to be fundamentally biased first to know what you're interested in. Then you need something to look at the charts to analyze. And all it's doing is looking for the top 20 most reliable patterns. And of that, I turned even half of those off. So I put it down to reversal patterns and trend patterns only to confirm or deny my bias. That's it. They're not signals. And these arrows are not buy and sell signals. Those are telling you if this pattern, it's just a pattern, it's just looking for patterns. This pattern, the next leg in the pattern is likely to be up. It's not a buy. Why would you buy this? It's a triangle with non-direction. It's a consolidation pattern. So you look at it and you're like, yeah, well, I think this is going to go down, but it's not a bearish pattern, and the next leg up of this pattern is bullish. This is definitely not a good opportunity for you if you're a bear. That's all it's saying. It's just like it's not worth looking at. Go look at something else. You're on the wrong time frame. What about this time frame on the 30? Same thing. Don't look at it. Well, what about the daily? And I think the daily was good. All right, so maybe not today, maybe later today you'll have that opportunity. So you need to know how to trade. If you think traders is going to tell you what to do, forget it. Hire somebody. If you don't know how to trade, then hire somebody with a track record and a license. Yeah. Okay. So we have all of this for crypto. Again, so I look at that non-directional pass, 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 pass. Well, that'll be interesting later. So the way I look at this is down and up and down. Okay, pass, pass, pass. Does anybody need help understanding these patterns? Like, for example, let me turn all the patterns on. I'll even turn the obvious ones off. Does anybody here need well, there's not a lot of these commodities. Interesting. There's no Gartleys going on anywhere. These are all pretty like this. Like, for example, do you know how to do this? I have free download that will help you. I just don't know what the link is. Is it a traders.com? I guess is it a product? It's a download. It would be an offer. I don't know which one it is. No. Anyways, maybe I'll email it to you or something. All right. All right. Yeah. All right, cool. So anyways, there's all of that. So we have implied volatility. We have news volatility. We have all the reliable, repeatable trading patterns on all time frames on all assets. We have all the fundamentals and commitment of traders reports and biases. We even have something like this that reads reports on FXstreet. Did you know that? Product. Check this out. We have AI that goes to FXstreet and reads all the reports and then tells us about the sentiment. Yeah. Yeah, so now, right? Which is kind of cool. Is it going to load? Yeah. Come on now. Okay, and what are we, about 4.5 minutes away? You guys excited? It's trying to load, but we can go to pivots. All right, here's what I want to show you as it loaded. Okay, so check this out. Great British Pound. Okay, we read 65 stories this week on 7 different websites about the British pound. Okay, one of those was FXstreet. The best by far is FXstreet. Look at, right? So we went to 7 different websites, read 65 articles about pound dollar over the last 7 days. We scored it as far as sentiment after reading the articles. Very negative. It just went slightly from negative to very negative this week. This is all based on this week. So the market seems to be bearish, pound dollar. And we can look at the 7-day average of bullish and bearish sentiment about pound dollar. We can go 30 days, 60 days, and 90 days to show you the history of market sentiment. So something happened right at the beginning of the year, bada bing, bada boom, to make pound dollar negative. Okay, so now it's reading the articles and scoring things. Yeah, traders.com's amazing. Amazing, amazing. All right, so let's get going. We want to, am I in the right one? Yeah, I guess so. Dollar. Yeah, taking a look here. Yep, cool. So we have a plan A and plan B. This is an old plan A and plan B. One of them was maybe a sell here, and the other one was maybe a sell here. And me doing these blue lines are trying to anticipate not just the price to sell, but the timing. And you can see the timing was a little off, but there's the sell. Very cool. I'm definitely bearish on this pair and have been for a while. Okay, so we're coming up to just a few seconds here. Hang on, I misclicked something. Why would it do that? Oh, I see what it did. Oh, funny. What is it doing? Sorry, having a little glitch here. What is it doing? I had it and I mistyped something and, well, let me try it again. Cool, that'll work.
What do the seasonal trends say about December non-farm payrolls? What technical levels are in play through the U.S. and Canada jobs
25
reports?
seconds.
Be aware.
U.S. non-farm payrolls data due imminently. The critical key ranges for estimates to watch.
Gold near upside resistance with December's U.S. employment report just around the corner. U.S. dollar
10 seconds.
ahead of December U.S. employment report. Higher commodity prices. Point to positive start on Bay Street. Jobs data info.
All right. Is it going to be bigger or less than 160? Unemployment 4.1. Oh my God, that's horrible. People got jobs. Oh, that's probably dollar strength. Oh my God. Come on, what's the headline number? So that was one, and we want to look at wages too. 256, it's horrible. 223, it's horrible. Oh, I knew it was going to be bigger. Oh, it's horrible. Dollar strength. Oh my God. The economy is great, and that's horrible. Dollar strength, y'all. Stock market's going to have a tough time. My gourd. That is something else, boy. Oh, I knew it was going to be higher, but that is so great. Yeah. So we're going to have to take some hikes out. Make sure you take a look at the Fed funds rate. Not the Fed funds rate, the Fed watch tool. Oh, my God. Yeah, it's so good. It's great, which means it's too good.
Non-farm payrolls, December has come out, 256K.
Focus. U.S. non-farm payrolls set to show hiring slowed in December after November's jump. Euro-US dollar exhibits volatility contraction as U.S. NFP looms large. Will U.S. dollar a data dump spoil the bullish party for corn? Brawn. Forex Live European FX News Wrap. Dollar steady awaiting jobs data.
So, huge headline and unemployment to 4.1. Oh my God. This is just like worst case scenario. That's a perfect storm, man. Oh my God. So this means the Fed may not even do 2 this year. Oh my God. Yields on the 10-year are going to go to 5. Oh, golly, man. So, and bear in mind, oil's going up and platinum's going up. And so we're getting inflation too. It's a double whammy. So, and I did talk about this last night. I did. There's a unlikely but possible scenario that the Fed actually ends up having to raise interest rates by the end of this year. Oh my God. Well, part of it, Osamu, is I think the reason the unemployment rate went up instead of just stayed steady is I think even people are dropping out too. So we'll have to look at the participation rate. Okay. Well, Big Perm, how do you attach the U.S. jobs to the Australian interest rate? How do you do that? I'm not following. But brutal, guys. That is massive dollar strength. We're going to lose some cuts. Now we're heading into some technical prices. The way that I use weeklies is I don't really, like if we blow through here, I don't care about this drop to 61 and a quarter. I care about the 61. I don't care about M0. I care about S3 if you're going to stretch out. But notice, like last week, Thursday of last week, so not yesterday, Thursday of last week, when we were here, these plans were created. I said Plan A and Plan B. Not even for 1 second did we talk about buying this pair. Now, Richard says euro parity. How many people here heard me say, probably a month and a half to 2 months ago, that I thought euro could go to parity, through parity, and drop thousands of pips below parity? How many people heard that? Cool. Yeah. Yeah, several times, right? So whatever, bro. So some people are shocked. Yeah, some people are shocked. If you're a trader, you shouldn't be shocked.
Pound yen finds cushion near 194.00. More downside remains likely.
Germany current account NSA rose from previous 12.5B to 24.1B in November.
United States non-farm payrolls registered at 256K, above expectations 160K in November. Canada unemployment rate came in at 6.7%, below expectations 6.9 in December.
U.S. December non-farm payrolls plus 256K versus Pubble's on 60K.
Dude, a lot of news just came out.
United States average hourly earnings year over year, below expectations 4% in December. Actual 3.9%.
United States unemployment rate came in at 4.1%, below expectations 4.2% in December.
Some people thought it was going to 4.4. All right, Mahaisa's got a basic question. The news is good. Why is the U.S. dollar strong? Because it removes interest rate cuts by the Fed. Okay, that's very basic. You need to know that, Mahai. That's very, very basic. Yeah. Yep. Yeah, you really, yeah. Oh my God, you definitely need that. So here we are on an S2 that is likely to be technical support, at least for a little bit. Is it a full-on reversal? I don't know about that. Okay, where do we go to find about expected interest rate cuts or hikes or pauses? Where do we go for that information so we don't have to guess? Remember, I don't like guesses. I don't like opinions. Oh, I think Bitcoin's going to go to 1 million. I don't care what you think. What can you prove? Okay. By the way, that's a kicker. Okay. Okay. Don't be surprised if you get a 5-minute and then a continuation, then a 15-minute and then a continuation. Yes, the Fed watch tool. Good, right? Once again, very, very, you need to know this stuff. If you guys are watching this and you're like, wait, I don't even know what he's talking about. You need to stay close, my friend, because this is basic stuff that you should know. Like, you should be doing this all the time. So if I'm like, yeah, Fed watch tool, let's pull up the Fed watch tool and look at all this stuff. If you don't know this, you need to stay close. All right? Because it just means to me, you don't know what you're doing. And if you just realized you don't know what you're doing, then you need to say, oh my God, I need to know this. I need to learn it. I need to master it. So stay close. This is basic stuff for institutional investors. Retail doesn't know anything about this, but you don't have to trade like retail anymore. You don't have to. Let's go. Let's trade like institutions. Okay, so current Fed funds rate, 4.25. So we're at 4.25. 93% chance right now the Fed is not going to cut in January 29th. Okay? You see that? Mahai says, I think it's a conspiracy to make U.S. dollar strong. You need to stop thinking like that. The conspiracy is what? The entire world is buying dollar because of its necessity for global trade, but also investors are now looking for safe haven. There's no conspiracy. So you need to, wherever you're getting that from, you need to turn that off. That's not helpful to you as a trader. And if you're getting it from some guru or some website, turn that off. Yeah. I'm saying that like I'm not slapping you or belittling you. I'm like, dude, that is not helpful. And it doesn't even make sense. So, yeah. So anyway, so look, now here's the thing. Let's go back a week ago, 93.6. 1 week ago was 89. 1 month ago was 72. So this went from 72 to 89 to 93, which means, okay, you guys following? Are you listening? This went down and this went up over the last 4 weeks. So money shifted this way. Okay? So there are many people in this room I taught how to look at this information years ago. Okay? Okay, so let me ask, just one question at a time, okay, folks? How many people were taught how to use the Fed Watch tool by me more than a year ago? Oh, Zach, I need to get back to you, man. Dude, Zach, thank you for sticking with me, man. Thank you. Dude, you're unbelievably patient and disciplined. Epic. I respect that. All right, more than a year ago. How many people? More than a year ago.
Breaking. U.S. non-farm payrolls rise by 256,000 in December versus 160,000 forecast. Oil jumps more than 3% on concern over more sanctions on Russia.
Okay, great. Now, the second thing is, so looks like at least 10 years or 10 people, probably more than that, learned this years ago. Okay, the second thing is, does this shift from to the right? Does that mean dollar strength or dollar weakness? What does that mean to you when you observe the shift from the left to the right? To the right, to the right. Grab your dollar, move it to the right. You see this, guys? Look at this. If you're in this live stream, first of all, click the thumbs up button. Come on. Click the thumbs up button. Not for me, but to FX Street for being awesome. Thank you, FX Street. FX Street's beautiful. You're beautiful. You're beautiful. You're beautiful. It's true. Yeah. 250 people. We should have at least 10 likes. Come on. Oh, 71 likes, 250 people. Oh, you're so generous. Yeah. Anyways, cool, right? Well, anyways, thank you, FX Street. I've been working with you for more than 20 years, probably what, 21, 22 years, since it was a little itty bitty website and I was a little itty bitty Forex trader. Very cool. Thank you for such a wonderful relationship, FX Street. And thank you, moderator. We have an amazing moderator that's been here for years and years and years and years, making sure everything goes smooth. Thank you, moderator. Okay, so if you're new and you're like, you don't know me, you've never met me before, even though I've been doing this webinar for 19 years. Okay, so you're new. Just think about it this way because, you know, this is a competition, isn't it? Right? This is a competition. This is like sports. It doesn't have to be like war. It's a competition. You have to really practice your game because, you know, every game is a competition. And you're trying to win games. You're trying to win championships, all that kind of stuff. And you're also avoiding getting hurt. Okay, great. There's at least 10, probably 25 people in this live stream right now that said they know exactly what this is, how to use it, and it's obvious to them that the dollar's strong. So if you're like, dude, I've never seen this before, imagine the other 20 things you probably don't know that you should be doing right now. So the way I work as a human being, like, I just want to know, just tell me. But when I first started trading, there were no gurus. YouTube wasn't even invented yet. Barnes & Noble was the only place to get books. Amazon.com was an online bookstore, but it didn't have any books on Forex. So then I went to Barnes & Noble. There were no books on Forex. Okay. So if you tell me what to do, then I grab onto it hard. You see?
Unemployment rate December has come out, 4.1%.
Breaking. U.S. non-farm payrolls rise by 256,000 in December versus 160,000 forecast.
Pound yen finds cushion.
By the way, do you like this squawk?
More downside remains likely.
Germany current account NSA rose from previous 12.5B to 24.1B in November. Oil jumps more than 3% on concern over more sanctions on Russia.
United States non-farm payrolls registered at 256K, above expectations 160K in November. Canada unemployment rate came in at 6.7%, below expectations 6.9 in December.
U.S. December non-farm payrolls plus 256K versus Pubble's on 60K expected.
United States average hourly earnings, year over year, below expectations 4% in December. Actual, 3.9%.
Well, that's good.
United States unemployment rate came in at 4.1%, below expectations, 4.2% in December. What do the seasonal trends say about December non-farm payrolls?
Neat, right? So most people charge somewhere between $100 and $400 a month to have a squawk like that running 24 hours a day in the background. So while you trade, you just hear the news. Hey, trader, did you hear the news? 256 on NFP. Hey, trader, did you hear the news? 4.1 on the unemployment. So I can just sit here burning through my charts and hear the news. So like I said, most services charge 100, 200, 300, even one was 430 US dollars because it was priced in pounds, right? Mine's free. I could have bought a car with the amount of money I spent. But instead I built something and I am giving it away for free. For now, maybe. But that's free. Isn't that cool? So anyways, we'll go back to here. Let me show you the future now. How many people would like to know the future? Well, nobody knows the future, but I'll tell you what. Where do we get this data? Okay, this is bank-to-bank lending. Smart money to smart money, negotiating the cost of billions and billions and billions, right? Billions and billions and billions of dollars. So we can go all the way out to March and May and June. Okay? Isn't that amazing? So let me tell you, when somebody says, hey, what do you think about the interest rates in the future? I say, well, the markets have priced in a 58.8% chance of at least one cut by June 18th, 2025. I don't think. I have the data, son. But I also track the change in positioning. Now, this is not an opinion piece. This is contracts actually negotiated. So when lending another bank $100, the average price, okay? So think of it. One bank lends the other bank money. They lend the bank $95.81. And in the future, that bank has to pay back $100. If you reverse engineer it, you can figure out the implied interest rate. And is it 4.25? Is it 4.5? Or is it 3.75? You can derive it through mathematics. And then you can look at the percentage of those contracts being settled at those rates because the price changes, right? That's the average price, which is probably in here somewhere, right? But some were lower, some were higher. The price determines what interest rate was negotiated from bank to bank based on their expectations of future Fed cuts, pauses, or raises. Oh my God! Isn't it crazy? Okay, so Harris says, why are like Aussie and pound weaker? Well, I can give you all kinds of data. Like I already showed you the COT obviously shows the pound weakening. I can do the same with the Aussie. So just institutional positioning is clearly bearish. I mean, there's all kinds of facts. I mean, let's see. Let me give the basic view. And then I'll show you, hopefully if I remember, I'll show you what I was going to show you. All right. There's two ways to derive this, okay? Why is Aussie dollar weak?
Breaking, U.S. non-farm payrolls increased by 256,000 in December versus 160,000 expected.
U.S. dollar jumps after a sizzling December non-farm payrolls report.
U.S. employment surges much more than expected in December.
All right. So the question is, why is Aussie dollar down? Oh, well, let's go over it. COT is neutral. Retail sentiment is bearish. Seasonality is bearish. The technical trend is bearish. GDP is bearish. Manufacturing is bearish. Service is neutral. Retail sales is bearish. Inflation is bearish. Employment change is neutral. Unemployment rate probably hasn't updated yet. Is actually pro-Australia, and interest rate differential favors the United States. So when you compare the macroeconomic economy in Australia versus the United States, bearish, 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 bearish technically, bearish seasonally, bearish economically, bearish by institutional positioning and retail positioning, is bearish, 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 bearish. But that's just a machine adding the math. If you want to be smart, first of all, you need to have the data. Like, you didn't know that? I'm going to win. If you and I are going to trade against each other, I'm probably going to win most of the time. I'm more informed. Now, if we go here and you go to webinars, there's a future webinar on Tuesday, and it's, where's the week on the street? There it is. On Tuesday at 4 p.m., we have something called the Week on the Street. Okay? And what I do is I download the governmental economic reports from all around the world. Australia, New Zealand, Canada, Japan, the United States, Europe, the UK, sometimes China. My voice is echoing. It's not echoing. I cloned myself using artificial intelligence. And I'm reading the news to you, but my lips are not moving. Yeah. This is why I'm giving it away for free. Does anybody want my $400 a month Squawk Box for free? Right? I run it on YouTube. It's not running today, but I'll run it on Monday. Subscribe here. It's just a YouTube channel. YouTube.com/@TradeRs. Subscribe there and I'll launch it on Monday. And now you have a $400 a month Squawk Box for free. Yeah, you're welcome. All right. So anyway, so I'll show you. So you go to webinars, and what was the last Tuesday? What was the date last Tuesday? On Tuesday was the 7th. So we got to go here all the way to 7th. And I do it late in the afternoon. 7 a.m. No. Oh, I have to go this one. I'm so busy today. Forgot to eat food. So I feel weird. I'm sitting down to get ready, right? And I'm like, I feel weird. All right. And then I can manage it this way. You skip forward here. Where is it? You know, skip ahead a little bit. G price is also increased. Uh-oh. Do you think the Fed might be a little bit worried that inflation's going to come back? Hey, do you think maybe that's why they took out 2 rate cuts? All right, so here's what I'm doing. I do it on Tuesdays. So here we are for this particular report. Sorry. We went to the Bureau of Economic Analysis. We downloaded one of the reports. I don't remember one of them. And we go through these reports line by line and talk about them, because I'm an economist and I know these things and I know the little tiny things. So we're breaking, this looks like PCE. So we're breaking down line by line personal consumption expenditures. Okay? But it's not just US-centric stuff. We go through global stuff. So let me skip ahead. See where that is. Peer economies. Okay, I remember this one. We're reading the meeting minutes from the Reserve Bank of Australia's interest rate decision.
Slightly slower.
And we go line by line by line. And I tell you what it all means. I don't just say 7.6 versus 7.7 expected. No, we go through it and I explain the economics behind the words and the numbers of what they're actually saying.
Australian dollar, US dollar rates below 2022 and 2024 lows. Trades at lowest level since April 2020.
US dollar CNH. Room for US dollar to retest the 7.3700 level. UOB group.
So when they talk like that, there's two things that squawk box does. When news comes in, it just reads it. So those two headlines just came in. Now, at the 15 on the hour and at the 45 at the hour, it does a review. And it reads like the last 10 headlines, just to keep you focused on what's happening. But like if something just comes in and talks over me, it just came in. Yeah. Isn't that neat? So if something is posted at FX Street that we believe is important to traders, we'll tell you immediately. Now, it's up to you to go to FX Street and go read the entire article. But we're like, dude, FX Street just posted this. You need to know right now. It's important. Hey, you're welcome. Hey, is free a decent price or should I charge you money? Competition's charging $200-$300 a month. How am I doing? Yeah, please subscribe over there on that channel. All right, so let's burn through some charts here. Okay, let's see what's up. Euro dollar's at a critical price. This goes back a very, very long time. Okay, so what we've been doing strategically is selling the 21 on the daily over and over and over and over. 444? That'd be interesting, huh? Yeah. If we had 1 million subscribers, right, Jim? Shoot, 250,000 subscribers paying $4.44. Yeah, maybe I can get my money back. Richard, I believe that, and thank you very much. You've been a loyal member of the community for a very, very long time. Thank you. I appreciate that. Okay, so anyways, up to the 21, sell, up to the 21, sell, up to the 21, sell. Guess what we talked about last week? Sell it off the 21, great, and now she's down again, back to support. The thing is, can we maintain this short-term trend? You see, I have the trend lines this way. Can we maintain that to the downside? Wouldn't that be killer, eh? So that's plausible. So that's strategic. Now, tactically, you're probably down here. And what are you doing? Well, if you're going to use price action, there's one way. If you're going to use Fibonacci, there's another way. So let me mark that. Okay, what about daily pivot points? Let's do that. Let's go to indicators, custom, biased pivot points, bearish mode, daily. Go. All right. So we're not interested in today. So this is something that I developed, right? I developed this. It's for it's now for traders, folks. This is Wednesday's sell zone. And it's only bearish. That's it. That's Wednesday. No, that's Thursday. This is today's sell zone, which was plotted yesterday, and yesterday was plotted the day before. And so now Monday's sell zone is here. You see it? which is the 50%. And this is probably a 786, 618, somewhere in there, roll reversal. So plan A, so let's put it together for those that are new. This should be basic operating procedure, plan A and plan B. What's up, Chrissy? All right. Okay, cool. Let's move on.com. Let's take a look at commodities. We'll do gold, oil, and Bitcoin, huh? Okay, oil's already on the move, and I talked about that earlier in the presentation, so let's skip that. Silver's on a tear. Okay, it's technically bearish still. So it's been up for a while. Okay, let me move this over. Okay, and there's still a high probability of this. Okay. It still exists.
Euro, US dollar. Markets are reluctant perhaps to push FX too hard. Scotiabank.
Pound sterling plummets on surprisingly upbeat U.S. job demand.
What's priced in for the Federal Reserve after non-farm payrolls? U.S. stocks may come under pressure after strong jobs report.
How about something like that? That would be a plan B. Plan A would be watch the moving averages on the daily. Plan B would be take head and shoulders off the weekly. Okay. Right, Big Perm says double bottom. Yeah, the thing that I cannot do, okay, is I cannot buy a lower low. Okay? I just can't do it. It's not how the Wayne do. So, yeah, double bottom. Yeah, but I'm not interested. That's the difference. So it'll take a while. Now, if it does sort of like this, I could do that. Yeah, I could do that. Yep. But I can't buy a lower low. I just can't. I won't. It's impossible. Okay? So I got to wait my turn. XAU, okay, great. Great. Finally, a break, maybe. Depends on how you want to measure this. Now, of course, I automate all this, so I don't have to waste my time. But I know how I would trade it even if I didn't have, you know, a radar doing it for me. So let's say we're likely to get up here. And let's say I wanted to be a bull. How would I handle this? Breakout, pull back, roll reversal, and then I would buy it and take it long and strong. Okay? So this is just the first wave of a potential pattern. The potential pattern would end up being like that. But are we there yet? No! No, we are not. We must get higher, okay, than this before I'm interested in. So we haven't even done it yet. Will it? Yeah, I wouldn't be surprised. But we kind of need something like this before I'm interested, you know? And then we're hot to go HOTTOGO. Okay? So you can burn through all these charts, or you can have a machine do it. Save you some time. Okay, let me show you how to do that. You go to technicals. And what are we doing? Gold and silver. So let's go to commodities. Oh, sorry. Turn all Forex on. All crypto is on. All stocks are on. All commodities are on. Good. And we'll turn all patterns on. All right. So let's go big. But do you want to do gold and silver specifically? Yeah, let's do that. Let's go back. Let's filter out commodities. Let's get rid of oil. Let's just look at these two metals and we'll hit save. And so gold and silver on 5 different time frames. So that is 10 charts. Okay, 10 charts. We're looking at 10 charts right now, and we're only looking for reliable, repeatable patterns. Some of these are reversal patterns. Some of these are trend patterns. Some of these are consolidation patterns. So you still need to know the patterns, and you need to know if you're a bull or a bear. So for metals, I'm assuming gold and silver have the same bias for you. So are you bullish on metals or bearish on metals? Tell me, please tell me. Okay, because if you don't know that, you don't know jack. You don't know how to trade. It's like playing some sort of sport. You're playing soccer, aka football, but you don't know what team you're on. So every time you get the ball, you don't know who to pass it to. You don't know what net to shoot at, but you're really good at playing soccer. Okay. Now, Ojo's neutral. Okay, so you're not interested, right? But bullish, but not jumping in. Bullish, bullish, bullish. Okay, everybody seems to be bullish, right? Okay, cool. So, descending triangle, does that exhibit? You guys ready for our SWOT analysis? It's time for SWOT analysis. All right, here we go, guys. Get ready. Let's go fast. Okay, silver. Does this exhibit on this time frame strength or weakness? S or W, strength, weakness, opportunity, and threat. Let's go. Let's be fast.
US dollar roars after December. Jobs report smashes it out of the park.
Pound retains a soft undertone. Scotiabank.
Okay. Well, I guess a slight delay on that. All right. Well, I'll tell you what. Then I'll do it. Okay. 3, 2, 1. This is a weakness. Therefore, that's a threat to me. I'm a bull. Okay. This is weakness. This is a threat to me. Okay. On this time frame, up, down, up, up and I'm going to say this is actually up to down. I'm going to call this weakness and a threat, but the short-term opportunity here, and then down. I think I'll just pass on that time frame. Too much vol. Notice the drop and the pop. See, these are live charts. You see that? Well, where did it go? Oh, no, not that one. Not that one. Let's do it again. Open in new tab. All right, here we go. You see, this occurred after non-farm payrolls. These are live charts. Stunning, right? Okay, take a look at this. And this is silver, and we're interested in buying. This is strength. This is exhibiting strength, and the next leg is up. That's an opportunity, yo. Yay, we found one. 90% of the charts are not worth your time on gold and silver. 90%. So of the 10 charts, I found one that agrees with me. So now I can look at silver, right, on the 4-hour chart and look to buy dips because I have congruency between fundamental bias and technical opportunity. 10 charts, and really it would have taken me 3 seconds. Meanwhile, you're pissing around looking at the wrong thing at the wrong time for the wrong reason. You're wasting time, son. This is why I put it up there. Check this out. Just like so straightforward. Traders.com, right? Stop wasting time. Focus. Cool, huh? Yeah. Cool. Very cool. All right. So, that's that. Well, we're worried about inflation. So you want to, right? You want to have inflation will lead to converting into now you're also like, well, dollar strong too. Well, there's two things going on here. Okay, fundamentally, the economy in the United States is smoking hot. And although, the one good part about NFP, the squawk, did you hear the squawk? I call it the headline news radar. I didn't see the number. I heard the number from my squawk, and it said hourly earnings actually fell. Well, that's one thing the Fed wants to see. That's actually good news. But there's a lot of strength in the job market. So that could be a temporary glitch. And also, I think it was only down like 0.1. So it's not that big of a deal, right? But there was a glimmer of hope. But generally speaking, the economy is producing a lot of jobs. And now, even with oil being up too, now the potential of inflation coming back. So there's like, okay, with inflation coming back, you might want to own physical assets. Food prices are likely to go up, real estate prices are likely to go up, and metal prices are likely to go up. And guns and bullets, anything real will probably increase in value. Now, that's because of inflation. Now, typically in a situation like that, you get dollar weakness. But we have an unusual situation right now. So that would be normal. That's what's in the textbooks. But we're in an abnormal situation because the inflation has come from over intervention by the government. Okay? Over intervention. And so this is a man-made problem. And the Fed has reduced their balance sheet by 20%, which is the right thing in the right direction. Federal government has done nothing to address inflation. Oh, but Wayne, they have the Inflation Reduction Act. Yeah, that didn't do anything. Doesn't even make sense. That didn't reduce inflation. Well, Wayne, inflation went down. Yeah. The supply chain got fixed. Okay. There's only one way to create inflation, by the way. There was a long time where we didn't know. So there was probably 50 to 100 years in which economists were studying the economy to figure out where inflation comes from. And then we solved that long ago. I don't have the book in front of me. I usually do. Okay.
U.S. dollar roars after December. Jobs report smashes it out of the park.
Pound retains a soft undertone. Scotiabank.
Euro, U.S. dollar. Markets are reluctant perhaps to push FX too hard. Scotiabank.
Pound sterling plummets on surprisingly upbeat U.S. job demand. Citi lifts its Brent forecast for Q1 25.
What's priced in for the Federal Reserve after non-farm payrolls?
Australian dollar US dollar rates below 2022 and 2024 lows. Trades at lowest level since April 2020.
U.S. dollar CNH. Room for U.S. dollar to retest the 7.3700 level. UOB Group.
Breaking, U.S. non-farm payrolls increased by 256,000 in December versus 160,000 expected.
U.S. dollar jumps after a sizzling December non-farm payrolls report.
All right, look at that. I read the news without moving my lips. Right. So anyways, yeah. So now we have this situation where the Fed was going to normalize interest rates by reducing them to the neutral rate, which 6 months ago, the market anticipated the neutral rate to be around 3.5. including the Fed. And then the recent Fed meeting gave us a summary of economic projections, which I read. And before the press conference even started, which shocked the world, because the Powell announced the reduction in rate cuts. We already knew because we downloaded the summary of economic projections, read it. I saw the shocking news. I couldn't believe it. I thought I was making a mistake in my interpretation. So I did it 3 times and I'm like, oh my God, they're taking out 2 cuts. Dollar's going to get ripper strong. Like, oh my God. Well, of course, that's what's happened. Okay, so what we just saw, ladies and germs, is the other part of this news event was that we're taking out future expected cuts. Future expected cuts lowers the value of the dollar. Just like I showed you in the Fed Watch tool, moving things to the right strengthens, moving stuff to the left weakens. Well, what we just did today is got the news, understood the numbers like wages, unemployment, and headline NFP, interpreted that into how the Fed would read it, and then made assumptions on future Fed policies into response to this, which would lead you to assume even less cuts, not 2 cuts in 2025, maybe only 1, maybe only none. Uh-oh. If it's 1, then the Fed just raised interest rates by 25 basis points. They haven't told us yet. We're making these assumptions into the future. Now, is it a raise? No, it's a removal of a cut. But we already priced the cut in, so now you got to price the cut out, which is the same as the Fed raising by 25 basis points from what we assumed. Now we unassume. And if you think they're not going to cut in July and they're not going to cut in December, now they're not even going to cut at all in 2025. Now you got to remove 50 basis points. You shift everything to the right because the Fed Watch tool would show that institutional investors are now negotiating the same thing. They don't think the Fed will cut at all. Therefore, the future interest rate will be higher than assumed, which means the price will be lower, and therefore everything shifts, and you get a stronger dollar. See, it's just that simple. Luckily, you have all this data. Okay, and we are in risk-off mode. Oh, faux show. Yeah, oh, for show. And the market is going to open in 10 minutes, and we're going to let the horses loose, and all of this is going to move. Okay? Well, yes. So Richard, and I said that in the first 5 seconds, right? Oh my God, dollar strength, stock market down. Yeah, if it costs more to do business. Okay, let's do something simple. I know you guys enjoy math. Okay. All right. Let's do some math. I'll do this in. Okay. All right, so we want to know how a change in future expected interest rates impacts a stock. So the expected return of a stock is equal to, the risk-free
Euro-US dollar moves lower after strong US jobs report.
rate of return minus the beta of the expected return, we'll call it SPX, of the stock market. Okay. No, wait, this is a plus. Expected return of the S&P 500 minus the risk-free rate of return because it's an opportunity cost. Oops. That's an F. Okay. All right. See? The stock value of the stock falls. Okay. Would you like me to explain this in greater detail, or do you got it? Okay. All right. Hang on. Where did you go? Where'd you go? Hang on. Where'd you go? There you are. Okay. Let's put it back. Okay. We have to start with the risk-free rate of return. Risk-free rate of return is equal to, oops. Okay. Risk-free rate of return you can use as the Fed funds rate, the yield on the 10-year, the yield on the 2-year. It's a variable. Okay? Great. So let's say we're going to use this as the expected Fed funds rate. So let's say the neutral rate went from expected 3.75, but now we expect it to be 4.0. Based on NFP. So now we're like, we thought this was the neutral rate in the future, but with the red hot NFP, now the Fed will cut one less time in 2025. Okay, so that means the difference means the risk-free rate of return went up. So you put the math in here. So it went up. So you do it, calculate it once. What is the expected return of a stock if the risk-free rate of return of, right, is 3.75? And then you do it again. Well, what if the risk-free rate of return is 4? And you do the math on all these things. Now, you might say the expected return of the S&P 500 is 10%. And then you do the calculation. This stock could be Apple. So what is Apple's beta to the S&P 500? Now, it's not just the S&P 500, it's opportunity cost. You have to say, well, the S&P 500 has risk, but its long-term average is 10, but I could just get 3.75 by just parking it, in a bank account or some other asset, right? That is risk-free. That's why. So really, if it's, right? So if it was 4.0, then really, when you do 10 minus 4, you're only getting a 6 on this, right? And then you have to do the beta. How much does Apple move up and down versus this beta? So you got to do it twice and figure out the numbers on each. But you'll notice when the risk-free rate of return goes up, it's the cost of doing business. It's opportunity cost. So, how do you say it? For most companies, you have a baseline cost of doing business. Cost. Okay? And then you run the numbers again, and costs have gone up. So, if Apple's revenue stays the same, but the cost of doing business for Apple or any other company in the world, in fact, that Apple's not a great thing, just XYZ Corporation. If everything else is equal, the cost of doing business, the revenue stays the same, but the cost of doing business, like your rent is a little more expensive, your insurance is a little more expensive, your employees are a little bit more expensive, your leases, are a little more expensive. Your borrowing costs by going to the bank or issuing a bond is a little more expensive, but revenue stays the same. Is the company more profitable or less profitable? Because now you have revenue minus cost, right? I'm trying to put this in very simple terms so it's obvious. Okay, if costs are up and revenue is fixed, is the company more profitable or less profitable? Less profitable. So you run this.
Gold attempts to snap upside resistance fueled by worried investors.
Wayne.
US stock futures are doing better than I would have expected.
All right, so you run this, you run it once, and you get the expected return of whatever particular stock. And it depends on your opportunities. It depends on what the market does in general. And it depends on its sensitivity to the market. So if the S&P 500 goes up 1%, does this stock usually go up 2%? If S&P 500 drops 1%, does this drop 2%? Or does it only drop 1.25%? Or does it only drop 0.76? That's what beta is. So you can do this for every stock. And you go through and you're like, okay, well, if the risk-free rate of return goes up, that is going to negatively impact the expected return for this individual stock. So what I'm saying is stock market down. Why? Based on non-farm payrolls, we can then say, ooh, we believe we know how the Fed's going to feel about this. And when the FOMC get together on the 29th, they're going to talk about it. And, well, they don't adjust the summary of economic projections. They don't adjust the dot plot yet, but their opinions are going to go, maybe 2 is too many this year. And if the market thinks that's how the Fed is going to think, then they're going to behave now. And what's the behavior? Stock market down, US dollars up. So that's why I blurted out in the first 5 seconds, oh my God, I'm like, oh my God, look at that, unemployment went down, oh my God, 252, that's crazy, we got a huge number. Stock market down, dollar up. I said it, boom, like in seconds. Why? Because I did the capital asset pricing model in my head. And just know it. You're just like, done. And this is what I thought about. This is literally the formula. What do you guys think? You want to do it a different way? Yeah, Wayne, do it a different way. Okay. You take the future value of an asset. And that is equal to, how do we write this? Am I doing this right? No. Oh, no. I know what I'm doing wrong. Okay. Do it wrong. Erase. Do it again. Okay. The present value of a stock is equal to the future value of, right, minus 1 over I to the n. Okay? Now, if we're talking about a stock here, what creates the value of a stock? What do you think is the leading thing for valuing a stock? Cash flows. Okay? Now, if it was an apartment building, what would that be? No, not dividends. No. Well, you're getting to it. So that's a cost. Profits. Thank you. Now, if it was an apartment building, you would look at rent minus expenses to get what? Your net operating income. Then you got to reduce, okay, the cost of your loan. And then you get your profit, right? Okay, that's how, and then you can do the math and very quickly, but you would want to do that over time, and there's a value to time. So we got to do this. So, all right, we're going to change the variable. We're going to say the future value, okay, is equal to profits. Okay, of what? Profits of that year. So N is equal to the year. Okay, how many years do you want to go out? Because now if you're trying to create a valuation, you would say, well, he might have had an awesome year. And by the way, you can artificially do that. That's in one of my training courses. Right? You can, like the government, you can overshoot and have above potential. You can be above potential GDP, but it's through cheating, right? So you might say, well, if I'm going to buy your company, I need to know what the price is. And I can't just take last year's revenue. You might go back five years backwards. Well, you can also project 5 years
Euro
forward.
US dollar slumps on surprisingly robust US NFP data.
So let's rewrite that. Okay. So profits, I'm going to use a symbol so I don't have to type it every time. We're just going to say profit. That which is equal to all the revenue minus all the expenses, ROI. Okay. All right. So we go to, now this is $1 in year one is equal to the profits over 1 plus, oops, sorry, 1 plus I to the second year. Wait, that's a plus. Wow, I'm really see, I can't think and I can't multitask. Okay, plus profits 3 years from now over 1 plus I to the n. Okay, so why am I doing this 1 plus I to the n in the denominator? What am I trying to get to? Why am I adding that variable? See, if you don't understand, then it's all pointless, right? There we go. So this is what you would do. Well, there's a way of looking at it. You can think of it as inflation, or you can think of it as interest rate. It's kind of similar. Do you understand? How many people here agree that there's some positive relationship between interest rates and inflation? Right? And inflation. So inflation goes up, interest rates go up, right? You guys see that? If there's high inflation, their interest rates are usually high. So I could be inflation or the interest rate. Yeah. So it doesn't really matter. You use the variable. So you can say, well, it could be the yield on the 10-year T-note. It could be the Fed funds rate. It could be the prime rate at banks. It could be the 2-year yield. It could be CPI. It could be PCE. These are variables. So we're going to say I is equal to the Fed funds rate. Okay. And now we're thinking forward. And we might have thought year 2 and year 3 were lower than our new analysis. So based on, like before the December Fed meeting, we thought there were for 4 cuts coming. So let's just say we thought 3.75 3 weeks ago. Now we think 4.0. Now meaning yesterday. And now, well, I guess let's do it this way. That's too much. I don't want to be too radical here. All right. So let's say we thought it was 3.25. And then yesterday we thought it was going to be 3.75. The future interest rate. So we're thinking these future I's in year 2, year 3, year 4, year 5. And now we're thinking, you know what? It might only be 4. We just priced out the June cut based on what we think the Fed is going to do once they get this NFP report and find out the economy is much stronger than they thought. So what has happened then? Okay. 3 weeks ago, 3 hours ago, and now interest rates have gone up relative to where we thought they would be in the future. So you're raising I. Okay? You're raising I next year and probably the year after and the year after. And I don't think there's going to be a massive cut all the way down. So our neutral rate might be 4.0 and might just stay there. There might be one more cut late next year, and if nothing else changes, we're stuck at 4.0 Fed funds rate forever. So, but my point is, it's going up over time. So you increase the I here, which is lowering your profits. Because if your cost of doing business, your loans, your bonds, your wages, your insurance, it's lower. The I going up lowers the profitability, lowers the ROI, and then you adjust this over time. That's what we're doing here. We're also incorporating future costs, and we're going all the way back, and based on what we think the profitability of this asset will be
US
5 years from
dollar yen moves
now,
up to swing
we know
area
the
target
present
and
value
backs
has
off.
just fallen.
Price stays within swing area.
Oil prices soar on talk of extra Russian sanctions, cold weather.
So that's another way of getting to the same thing, using completely. So this is a discounted cash flow model, and we're adjusting our I, our risk-free rate of return. I is really the Fed funds rate, or I could be a treasury. But using either discounted cash flow or the capital asset pricing model, NFP comes out and I go snap, 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 snap down. Just like bada bing, bada boom, right? Cool, huh? Did anybody find going through the math of those two valuation models helpful or interesting? Let me know. Yeah. Right? So you need to be able to understand what NFP is and is not. You need to understand the important parts of it. So wages were good, unemployment rate was bad, headline number was bad, meaning bad, but you're like, that's good. Yeah, okay, that is all good. But if you wanted the Fed to cut interest rates, then the good news is bad. Then you have to say, so if the Fed interprets the good news as bad and that they can't cut interest rates, then then you have to see the Fed watch tool shift to the right. You have to see the capital asset pricing model making the valuation of an individual stock fall. And of course, it's the same for all. So that would probably drag the entire S&P 500 down, except for the companies that are not exposed as much to those types of costs. So now you're like, I'm not even looking at it, but I would assume Russell is getting crushed. S&P 500 will be hurt. NASDAQ will follow along for a while, but dude, if you're a NASDAQ company, you're not borrowing. You're not issuing bonds because you don't have enough cash. Dude, you're probably cash heavy. So if you're cash heavy, you don't lease your equipment, you buy. So the interest rates go up. It just makes you more competitive because now your competitors are less profitable because they're spending more money just borrowing. And you're like, I don't borrow. So now you got more money to compete. So while they're simply paying more for their mortgages, you're putting that spare money into advertising and you're taking market share away from your competitors. So now you could really be smart and say, well, you understand what NFP was, you understand its likely impact on monetary policy, and then you could run it through the capital asset pricing models or the discounted cash flows, or you understand the Fed watch tool, and you're like, aha! And then you can start breaking the market apart. Who's going to be hurt? Who's not going to be hurt? And now you can start picking winners and losers based on those variables in your assumptions. If you can't do it in your head, you're too slow. Because doing it in my head, well, there's probably algos that can do it 1,000,000 times faster than I can do it in my head. Okay. Yeah. So let's zip back over and get some data here. Let's see if these opened up. Okay, yeah, so good. We finally got that dollar data in. So we fixed it. Thank you, engineering team. Thank you. And what are we looking at? Down, down, down. Down. Now, I want to show you this. Let's see if my assumption was somewhat correct or somewhat not correct. Only look at indices. All right, Russell's down the most. Is that what I just said? So tell me, did I say Russell would be down the most? And can you tell me why? Remember, I did it in my head in less than 1 second. Type in a question mark if you didn't follow along and you're not sure what I just told you 2 minutes
Brent
ago.
breaks $80 as the oil bulls put on the squeeze. US dollar yen moves up to swing area target and backs off. Price stays within swing area.
Euro US dollar slumps on surprisingly robust US NFP data. Gold attempts to snap upside resistance fueled by worried investors.
US stock futures are doing better than I would have expected.
Oil prices soar on talk of extra Russian sanctions, cold weather.
Euro US dollar moves lower after strong US jobs report. US dollar roars after December. Jobs report smashes it out of the park.
Pound retains a soft undertone. Scotiabank.
Euro US dollar. Markets are reluctant perhaps to push FX too hard. Scotiabank.
Okay. I just explained it literally 2 minutes before. Russell is likely to be hurt more by non-farm payrolls because the interpretation is the Fed will cut less. They already told us they were going to cut less, but now they're going to cut even less than less. So in the last 3 weeks, the effective interest rate in the United States has gone up by 0.75, which means the cost of doing business for those that need to borrow or lease has skyrocketed in 3 weeks. So therefore, there's a difference between companies that don't borrow and the companies that do borrow. Dow companies are giant multinational monopolies. The S&P 500 is a balance of large growth and value companies, and NASDAQ is super tech heavy, some of which have more money than God. So do these guys go to the bank and beg for money? Do they issue bonds? Well, they might issue bonds, but who has to pay the most? Small companies. So I said the Russell's likely to be way down much more than the others because they borrow, they lease, they have costs. They're smaller businesses. They don't buy a factory, they lease the equipment. And those are variable rates, so their cost of doing business just went up based on the assumption of less future cuts, which is the same as raising interest rates. And therefore, these companies are less profitable. And you already told me you value a company based on how much profit it makes. These companies are now, based on NFP, less profitable, probably. And we know the stock market is always thinking 6 to 12 months in advance. So you would have shorted this instantly after NFP, if you understand. Oh, but Wayne, I always trade E-mini futures. Whatever, bro. You don't get it. Cool, right? Am I right? Hey, look, yields went up. Remember, we said what? You can use the risk-free rate of return could equal Fed funds rate, right? Or it could represent a 1 year, a 2 year, a 5 year, a 10-year treasury yield. Guess what? Up. I also said that would negatively impact Russell. Down. It's like it should take you 1 second to understand everything fundamentally so that when you go to your charts, you know what you're looking for. I think newer traders, they master technical analysis first, which means they have a beautiful technique for doing the wrong thing at the wrong time, and they don't even understand the reason for which they're doing it. They're betting their life savings because MACD told them to. Oh, really? Huh. Yeah. Well, hell's bells. Yeah. Look at that kicking off the central pivot. Oh, look at that. Oh, it's so beautiful. Hey, do you want to see what to do on Monday? I'll leave it with this. Let me show you what to do on Monday. But I want more likes. Give me some likes and I'll end with a pound yen trade for Monday. Give me more likes. Gimme, 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 gimme. Well, you're not giving it to me. You're giving it to FX Street. Thank you, FX Street. Thank you, moderator. Thank you, guys. Give me some more likes and I'll give you one more golden nugget. Those are hearts. I appreciate it. That means you already gave likes. Okay. Did you sign up for the free squawk box I'm going to release on Monday?
Energy stocks rally. Tech and semiconductors face pressure.
Who wants the free stock as well? I call it the headline news radar. Okay, you need to subscribe there. I think I got that right. How many people want to get my 2025 annual outlook? You can watch it right now. We recorded it a day and a half ago. Well, no, yesterday? No, 2 days ago. Day and a half ago. Day and a half ago, I gave an outlook. It's 2 hours long for the year 2025, and there's 3 follow-up meetings we're going to include. Okay, this is your last chance because the video will be deleted in 5 days. Here that is. So it's $50 for this one, the next one, and next one. They're all included, all 4 meetings for a lousy $50. It's $12.50. And it'll give you access to this immediately. So you log into the quarterly sessions. This was the presentation room. Here's the recording. It'll be there 5 more days. You click on it. It's big, it's beautiful, it's pretty. So let's go through a basic timeline. Okay, cool, right? Check it out, dude. It's month by month. It's excellent in my humble opinion. The link is here. And now, so there's the annual outlook. You got the free squawk. I've given you a lot of value. Okay, so let's end one more trade plan, and then it's the weekend. I am going to go to my indicator list. I am going to go to my biased pivots. I'm going to make this a bear trade. I'm going to pop it in. There's today's sell. Look at this. Look at yesterday. Let me just show you. Okay. Let me just show you. I'll do this in black so we can see it. Okay. Friday, Thursday, Wednesday. Wednesday, sell. Here's the target. Okay. Thursday, sell. Here's the target. Today, sell. Oh, now, first of all, does this look amazing? Because we do this in the future. So you knew this the day before. Lower low, lower high, sell. Lower low, lower high, sell. Lower low, lower high, sell. You don't know that? You don't know how to trade. Okay, cool. So let's plan the future, son. All right. So what does it say? Well, the trade plan that you could have developed yesterday is sell here. And then it says bearish profit target conservative, bearish profit zone aggressive. Down, up, and sell. Monday. That's that. Oh my God. Thank you, FX Street. Thank you, traders. Thank you, traders. Thank you, Traders Way. There's Traders Way. There's traders for traders for you, right? FX Street, everybody, moderator. Everybody have a wonderful weekend. I have snow on the ground. Oh my God. Yeah, crazy. It snows here maybe every 3 years. So wowzer. Yeah. Cool. So look, I want you to succeed, and my belief is the only way for you to succeed as a trader is to radically change everything you're doing. There is no excuse now for you to continue to trade like an amateur. I have built an infrastructure and coaching team that will help you trade like an institutional investor. You'll make institutional quality decisions, both fundamentally and technically. You'll be looking at the right thing at the right time for the right reason, and you will have the confidence and strength to get out of bed and do what needs to get done, or you're just going to keep doing the same thing over and over and over and over and over as an amateur trader and expecting different and better results. And of course, that is insane. So don't be a lunatic. Join traders.com. Radars for traders. Have a wonderful day. Cheers. Thank you for your time and your attention.